P/E price to earnings, the most famous number in the stock market,
used every day by investors around the world. But what does it really mean?
The P/E ratio shows how much investors are willing to pay for 1 unit of a company's profit. It tells you how expensive a stock is compared to what it actually earns. It is one of the simplest ways to see how the market values a business.
Let's say a company's share price is 100
and it earns 20 per share. Divide the price by the earnings and you get a P/E of 10.
That means investors pay 10 times the company's profit for each share they own.
A low P/E can look cheap at first glance,
but it does not always mean undervalued. Sometimes it just means investors expect very little growth in the future.
Low numbers are not always good and high numbers are not always bad. A low P/E can mean safety and stability, or it can mean the business has stopped growing. Value or trap, that's for you to decide.
That is what makes investing an art, not just math.
A high P/E often means big expectations. Investors believe future profits will grow.
But they might also be paying too much for hype and potential.
Because hope is expensive when it comes to stocks.
The key is context. A P/E of 30 might be normal for a tech company,
but look absurd for a bank or a shipping firm.
Every industry has its own average that defines what cheap or expensive means. Always compare today's P/E to its own history. If it's far above average, expectations could already be priced in, and when expectations break, prices usually follow.
That's why understanding P/E is more than numbers. It's about what the market believes will happen next. P/E alone never tells the full story.
It must always be seen together with growth and risk.
A company with a low P/E but falling earnings is rarely a bargain, and a company with a high P/E but strong growth might still be cheap. That's why investors look at trends, not snapshots. A stable or rising profit makes the P/E more reliable.
But when profits drop, the ratio can shoot up and give a false signal. During bull markets, P/E ratios expand because optimism drives prices higher.
In bear markets, they shrink as fear and doubt take over.
Different sectors also behave differently. Energy and banking often trade at low P/E, while technology and healthcare stay high because growth expectations are stronger.
And then there is forward P/E. It uses analyst estimates for next year's earnings.
It shows what investors believe will happen, not what already did.
But forecasts can be wrong and markets punish missed expectations fast.
Another version is the PEG ratio. It compares P/E to expected growth.
If a company has a P/E of 20 and grows 20%, the PEG is 1.
That means the price matches its growth.
But remember, these numbers are guides, not guarantees.
They show where the crowd is looking, not where truth always lies. Smart investors use them as one part of the puzzle, not as the answer itself. In the end, P/E reflects human emotion as much as financial logic. Greed pushes it higher, fear drags it lower. It's a mirror of confidence in the future.
And that is why it remains one of the most powerful numbers in finance.
Understanding P/E helps you read how investors think, and once you learn to see what they believe, you can start to find value where others see nothing. That's how great investors build their edge.
And how you can too.
P/E is simple to calculate, but understanding it takes experience.
Numbers can look clean on paper, but markets move on emotion and belief.
Every ratio tells a story, and P/E tells the story of trust. When investors believe in the future,
they are willing to pay more today.
When they lose faith,
the same company can suddenly look overpriced. That's the power of sentiment. It can turn numbers into opportunities
or into traps. The goal is not to chase high or low P/Es.
It is to understand why they exist and what they say about the people behind the price.
Because behind every chart, every ratio, and every line,
there are human choices, driven by fear, hope, and greed. The P/E ratio is just a reflection of all of that, a mirror of what people think the future is worth.